Guys, there is a $7 trillion wave building behind the scenes, and most investors are only staring at one ticker instead of the whole shoreline. Everyone talks about AI, about chatbots and flashy apps, but very few people stop and ask a simple question. Where does all that digital intelligence actually live? It does not live in some magic cloud. It lives inside real buildings, filled with real hardware, sitting on real land, plugged into very real power grids. And that physical side of AI, the data center backbone, is where the next decade of serious wealth and long-term dividend income can quietly be built. Today, I want to walk you through the full AI data center stack, how money is flowing through it, and how a patient investor can tap that flood. As always, make sure you're subscribed to Dave's Dividend Lab, hit that like button if you enjoy deep dives like this, and ring the bell so you never miss new breakdowns. Because this is not just about chasing one hot stock. This is about understanding an entire ecosystem and deciding where your dollars can work the hardest. Think about every question you type into an AI model, every image you generate, every transcript you create. None of that happens without data centers doing the heavy lifting. These are buildings the size of football fields, stuffed with servers, cables, batteries, cooling systems, and backup generators, humming away 24 hours a day, 7 days a week. Analysts expect data center power demand to multiply over this decade because AI models are hungry. Every upgraded chip pulls more power and spits out even more heat. When you zoom out, the AI boom is really a story about 3 layers. Compute at the bottom, the physical facilities around it, and the hyperscalers tying everything together. The compute layer is where you find GPUs, CPUs, memory, networking gear, and all the semiconductor supply chains that feed them. This is the fastest growing and most volatile layer. Then you have the facilities layer, the shell around everything. Power infrastructure, cooling systems, electrical gear, real estate, and the companies that own and maintain those mission-critical buildings. On top sit the hyperscalers, the big platforms that design custom chips, sign long-term power deals, build out entire regions, and rent capacity to almost every other serious AI user. If you only focus on one famous chip name, you miss how money moves through all 3 layers. You miss who collects rent, who gets paid, and who takes the real risks. For the Dave's Dividend Lab community, I want to reframe this entire map around 2 simple goals: consistent dividend income and long-term growth that compounds quietly in the background. We are not trying to guess the next meme ticker. We want durable cash flow, realistic growth, and a portfolio that survives when excitement cools and headlines move elsewhere. So here is the big idea. Use the compute layer for targeted growth, the hyperscalers for balanced strength, and the facilities for stability and income, then blend them intelligently. The data says most of the upside lives in compute, but most of the stability lives in facilities. Hyperscalers sit right in the middle, touching almost every part of the stack. Let us start with compute, because that is where everyone's attention sits right now. This is the engine room, and it is moving at an incredible speed. This is where companies design and manufacture AI accelerators, high-bandwidth memory, cutting-edge networking, and the servers that pack everything into dense racks inside those data centers. Growth rates in parts of this layer can easily run in the 20s or even higher, because every new model, every new training run, demands more compute than the last. The upside is obvious, but the risk is also real. One new chip design, one manufacturing setback, or one shift in architecture can reshuffle market share almost overnight. So, as dividend-focused investors, I like to think of this layer as our growth engine. It deserves meaningful exposure, but not the entire portfolio, and not all at once. Inside the compute bucket, I personally break it into 3 subgroups: core chip makers, the memory and storage providers, and the companies turning all that silicon into actual systems. In the first subgroup, you find the names designing AI accelerators and advanced CPUs, pushing performance forward every cycle. These are the companies everyone talks about during earnings season. The second subgroup is memory and storage, often overlooked until demand explodes. High-bandwidth memory has become essential for modern AI training, and shortages can send pricing and profits sharply higher. The third subgroup is server manufacturers and networking gear, transforming chips and memory into dense racks, then linking those racks together with ultra-fast switching and optical connections between facilities. When I think about dividends and reinvestment, I treat these compute names as higher beta positions inside the portfolio, with smaller allocations but strong potential for reinvested growth over many years. That means I am comfortable with more volatility here, as long as I keep the position sizes reasonable and pair them with more defensive exposures across the other layers. Now let us shift into the facilities layer, which almost never makes headlines but quietly powers everything behind the scenes, quite literally in many cases. This layer includes companies providing transformers, switchgear, backup generators, cooling equipment, thermal management, and the specialized real estate that houses entire campuses of racks and cables. It also includes parts of the grid and infrastructure contractors that build out new substations, extend transmission lines, and harden the local networks that keep these data centers live. This side of the stack tends to grow slower, maybe high single digits to low double digits, but revenues are tied to long-life assets and long-term service relationships. In other words, more stability, more predictability, and in many cases, cleaner dividend histories. These are the companies that keep collecting checks as long as the lights stay on. And if the AI build-out continues for years, new projects and upgrades continue feeding their order books, even if any single chip cycle cools off for a while. From a portfolio design perspective, I think of facilities as the ballast. These holdings help smooth out volatility while still giving you exposure to the long-term AI trend. Many of these names already lean into dividends, or at least reliable free cash flow that can support shareholder returns. That fits perfectly with an income-focused strategy. Next, we have the data center real estate owners, which often operate as real estate investment trusts, leasing space, power, and connectivity to the rest of the ecosystem. They sign long-term agreements, provide interconnects between tenants, and invest in upgrades that keep their campuses attractive for hyperscalers, cloud providers, and enterprise clients that need reliable capacity. When you combine utilities, electrical equipment providers, cooling specialists, and data center real estate, you get a diversified backbone of companies tied directly to AI infrastructure spending. These are the names I look at when I want dividend resilience that still participates in the AI theme, without depending on one specific chipset or product cycle. Finally, let us talk about the hyperscalers, because they do not sit neatly in either bucket. They touch compute, facilities, and software all at the same time. They design custom chips, negotiate huge power deals, build regions full of data centers, and run the cloud platforms where most enterprise AI workloads actually live day to day. In a sense, they are the landlords, the architects, and the operators of the modern AI economy, collecting revenue from thousands of different customers across many different industries. The growth here is slower than the pure chip winners in a hot cycle, but the scale is enormous. The moats are deep, and the cash flows are substantial. For a dividend-oriented investor, these names can anchor the growth side of the portfolio, sitting between high-flying compute and slower-moving infrastructure and real estate. So how do we turn this entire map into something practical, something you can actually act on with real dollars and clear expectations for risk and reward? I like to imagine building a $100 model portfolio across the data center stack, then asking how each slice should work for you over the next decade. In my framework, $45 go to compute, $30 go to hyperscalers, and $25 go to facilities and data center infrastructure. This mix leans into growth where demand is hottest, keeps a strong core in diversified platforms, and anchors everything with boring but essential power, cooling, and real estate income. Now, those numbers are not perfect or magical. They are simply a starting point, a template that you can tilt more conservative or more aggressive depending on your risk tolerance. If you are closer to retirement and want smoother income, it might make sense to shrink the compute slice and add more to facilities and dividend-heavy infrastructure. If you are younger and comfortable with volatility, you might push more weight into compute and hyperscalers, especially if you can reinvest dividends and add new capital during drawdowns. The important thing is that every dollar has a job. Growth dollars chase compounding, core dollars focus on resilience, and income dollars make sure you get paid while you wait. From there, diversification matters. You do not need 50 tickers, but you probably do not want to rely on 2 names either, especially in the more cyclical compute bucket. I prefer clusters. A handful of chip and memory names, a handful of service and networking names, a handful of hyperscalers, and a handful of infrastructure and real estate names. Think of it as building a small ecosystem inside your portfolio, mirroring the real-world ecosystem that keeps AI models running 24 hours a day. Now, as always, none of this is financial advice. It is educational research to help you build your own framework and ask better questions before putting any dollars at risk. But I want to make this as practical as possible, so let us imagine how that $100 model might evolve over the next 5 years. If compute compounds somewhere in the low 20s annually, hyperscalers in the low teens, and facilities closer to high single digits, that simple mix could roughly double over 5 years. That is not a prediction, it is a scenario. It shows how different growth rates interact when you deliberately weight the high growth, medium growth, and steadier income layers. The beauty is, you do not need perfection. You do not need to guess every earnings report. You need a clear thesis, a reasonable structure, and the discipline to stay consistent. And in my opinion, the AI data center build-out offers that kind of structure. Compute fuels the excitement, facilities anchor the cash flow, and hyperscalers bridge everything together at scale. If you are getting value from breakdowns like this, from the way we map entire ecosystems instead of chasing headlines, take a second now to like the video and subscribe. Drop a comment telling me which layer you feel most comfortable investing in right now, compute, hyperscalers, or facilities, and which one you want me to break down next. Now, whenever we talk about fast-growing themes, I always like to remind the community about concentration risk, valuation risk, and emotional risk when prices move quickly in either direction. Concentration risk is simple. If one ticker secretly becomes half of your portfolio, no ecosystem map can save you from a bad surprise in that single business. Valuation risk shows up when expectations outrun reality. Even a great company can deliver mediocre long-term returns if you overpay during the loudest part of the hype cycle. Emotional risk is when volatility pushes you into buying high and selling low, turning a thoughtful strategy into a roller coaster you never meant to ride. That is why I love pairing exciting growth engines with slower, steadier cash generators within the same theme. It helps you stay invested when headlines swing from euphoria to panic. When you see data center construction headlines, new chip launches, and grid upgrades, you will know exactly where they fit within your portfolio map and what role each position plays. Over time, you can rebalance. Trim winners that have outrun their weight, add to steady compounders that are still reasonably valued, and keep new contributions aligned with your target mix. This turns the AI data center boom from a vague story into a personal plan. Not just something happening out there, but something building real assets and dividends inside your portfolio. And remember, you can also use broad funds or themed vehicles to simplify the process, especially for the infrastructure and real estate segments, if researching single names feels overwhelming. The key is matching your tools to your temperament. Some people love deep single stock research, others prefer baskets. Both approaches can work inside this 3-layer framework. As we look ahead, I think the most underrated part of this whole story is time. These facilities take years to plan, build, connect, and fully utilize. That means the revenue and cash flow ripples can stretch across an entire decade, even if the headlines shift to the next shiny technology trend in a few months. If you can be patient while the concrete dries, while new substations come online, while capacity fills, you give compounding time to do its quiet, powerful work. So when you hear people say AI is just a fad, remember the physical reality, the steel, the copper, the fiber, the power plants, and the servers humming away. Those assets do not disappear because the news cycle moves on. They keep delivering bits, watts, invoices, and, if you choose carefully, growing streams of dividend checks. My goal with this channel is to help you see those connections clearly, so you can build a portfolio that benefits from megatrends without being held hostage by hype. If that sounds like the kind of investing journey you want to be on, make sure you are subscribed, tap like, and share this with another long-term investor you respect. And if you made it this far, let me know in the comments which part of the AI data center stack you want a full deep dive on next. Before we wrap up, remember to build your own watch list. Map each company you study to one of the 3 layers so you never forget what role it plays. You might even color code them in your notes, one color for compute, one for infrastructure, one for hyperscalers, so portfolio decisions become much clearer at a glance. For the dividend-focused community here, I also like tracking payout ratios, dividend growth rates, and balance sheet strength, especially in the slower-moving facilities and real estate segments. When a company is funding dividends with real cash flow from essential infrastructure, that is very different from a company stretching just to maintain a headline yield. Personally, I prefer slightly lower yields with clear runway for growth and reinvestment, instead of stretching for the highest yield in the most fragile part of the ecosystem. That mindset can help you stay out of trouble when excitement around AI pulls weaker businesses into the spotlight just because they mention data centers or digital infrastructure. If you want more help organizing this theme, let me know in the comments whether a full spreadsheet tour or portfolio walkthrough would be most useful for you. I am always refining my own frameworks, and your feedback helps me decide which pieces to share next, from allocation examples to dividend tracking templates and scenario models. At the end of the day, the goal is simple: build a portfolio that sends you growing cash flow while the world quietly builds out the future of computing. And the AI data center backbone, in my view, is one of the clearest places where that future and those dividends can meet over the coming decade. Until then, stay patient, stay focused, and let your capital compound in assets that are doing real work in the real world every single day.